Hey YouTube, welcome back. This video is about how to roll a put credit spread. I've got this Roku put credit spread that I've already rolled once. It's gone against me. I sold a put at 90 and then I bought a put at 84. And right now it's a little bit in the money. The stock price is 88.81, so it's between the two strikes. I do have a little time. It's midweek, it's Tuesday. And this is Friday the 26th when this expires, so I got a few days. But I just wanted to kind of show you how to roll out a put credit spread if you start going in the money. So right now, if I want to buy this back, it's going to cost me $251 to close this out because I would have to sell the 90. I would have to buy back the 90 and sell the 84 to close this out. And with Robinhood, you can do this all in one step. But if this does go below, it's gone below both my strike prices. If the stock price ends up at expiration below both of your strikes, then they'll both be activated simultaneously because they're both in the money. So you'll incur the max loss. So that's $90 minus 84, which is 6. So that'd be $600 less the initial premium that it was made. I think I made $100 or something on this initially. But like I said, I did roll this out once and I only got like a $15 premium, trying to get a little more time so that this can go back out of the money and I can close this out. So right now the same thing is happening. It's a little bit in the money and I don't want it to go all the way, incur my max loss. And that would be a reason why you would want to close this out. But I wanted to show you, you can see Roku has, when I bought this put, it was kind of way up and it's just kind of gone down. It's floated right around between 90 and 84, which is right where my strike prices are. So a put credit spread has two legs. You buy the one put at a certain price and then you sell another put at a lower strike price. So to reverse that, you can see here I've bought I sold the put at $90, then I bought a put at 84. So to reverse that, you want to pick the same expiration, 1/26, and then buy a put at 90 and sell a put at 84. So let's go do that right now. We'll buy a put at 90. Let's go to Roku. Like I said, with Roku, you can just click the one button and close it out. But if you have a different kind of brokerage, you might have to do this in multiple steps. So I would go trade option. A put credit spread has two legs. So you pick your expiration, and you sell a put at a certain price, and then you buy another put for protection in case the stock price really drops. You're not stuck holding the bag. You buy a put at a lower strike price. So the difference in between is the spread. And this is a bullish strategy. What you want is the price to remain above the short strike price, which is the $90. If it does, then you end up with the maximum premium. In order to roll this out, what you need to do is just reverse what you did here. So you pick the same expiration, 01/26, and then because I sold a put at 90, I'm going to buy a put at 90. And because I bought a put at 84, I'm going to sell a put at 84. So I sold a put at $90, so I'm going to buy that back. So I'm going to go buy, put, same expiration, 1/26. You can see here, buy the put, $90, 1/26. And you can see I've got the -1 here, which means I've sold a put on that. I'm just going to buy that back. It's going to cost me $325. And then I'm going to go then sell a put with the same expiration. I hear sell a put for 84, which is the other leg of this put credit spread. You can see it's got a +1 here, which means I've bought a put on this. And I can select that. That's going to give me a credit of $66. So I end up right around a total cost of $259. And I'm not going to do this right now because I do have a little bit of time. I just want to show you this as a demonstration. Not going to do it because I've got time before expiration. I want to see what this does and see what the time decay does because I can probably buy this back cheaper. But I would just hit continue and then move on to the next step. Now you can see the price. The cost would be like $259. That's pretty close to the cost of just the one button click here to close, $251. So that's kind of similar. Robinhood makes it easy. If you just wanted to go this route to close this out, you just hit close and review order. But if you did have a different brokerage, you'd have to go close out each leg like that. Then the next step would be to roll this out to a different expiration date and choose your strike prices. So I'm going to go back to Roku, trade Roku options. Robinhood has a builder here that you can click, and it's got some predefined spreads, single leg, like long call, covered calls, straddles. And so you can choose a put credit spread here. And it starts off with $1 width, so buy at 90, sell at 89. You can change the width to like 5. And I would like to choose an expiration maybe. And let's go look for something that is, since it costs us $250 or so to close this out, you want to cover yourself with that, maybe make a little more premium. So that would be $258 here. This would do it at a strike price at 91 and 86, but it's been trading well below 90, so I don't think I want to do that. I'm going to go and do this manually. So I'm going to go back to Roku and trade options. I'm going to sell a put February 9th, 90. That's going to give me a credit of $510. Then I can go out to what I had before was 84, so I would go buy a put at 84. That's going to cost me $247, so I would end up with $263. So it's about break even. I would make a little bit more than like the $251. So similar to my last roll, I ended up with like a $15 credit just to see if I could roll this forward and hopefully have the price go out of the money and close it out. But what you can do is you can change the leg to a little bit lower here. So that would give me credit at 298. Subtract what it costs to close this out, 251. I'd get a little bit more. But that opens you up to a little bit more risk on the total loss, because it's the difference between the 90 and the 83, which would be $700 loss if it went below both of the strike prices. So I'm going to choose same 84, but I'm going to go out in date a little bit more to see if I can get a little bit more premium. So I'll go out a little bit more, one more week. So sell put at 90. That's going to give me credit at 810. Buy put at 84. 525. That's roughly the same amount. If I chose a different leg here, let's 83. If I went down in price a little bit, that would give me a total credit of 325. So subtract the 250 roughly that I made, that I had to pay to close this out. That would give me around a $75 credit just for rolling this out a little further. So you have to kind of play with it, see what you want to do. If you just want to break even and cover your costs, I don't think I want to wait this long. So you have to kind of choose for yourself how you want to do this, but that's pretty much how you would do this. So I would go 90 here and 83, and the expiration was, what was it, February 16th. It's pretty difficult to roll these out compared to like a cash secured put or a covered call, but that's how you would do it. You can just play around with it and see what you want to do as far as like making a little more credit or just closing it out. Another thing you can do is just close this out and take the loss. So this would be right now $251.06 loss. But I got some time. I don't want to do that, so I'm just going to let this ride for a couple more days and see what happens. The market seems like it's been improving quite a bit, so we'll see what happens this week. That's it for now. Thanks for watching. Bye-bye.